ETFs are a great investment opportunity when you are looking to get the most exposure for your buck. During a bear market, they can be a safe, low-maintenance option. ETFs tend to lean more towards blue chip than not. Today, we will look at some blue chip ETFs, and we will begin right now. An exchange-traded fund, or ETF, is a bundle of stocks that is managed by the company that, provides the ETF to both minimize risk and hopefully maximize your return. If one company is struggling in a basket of companies, the other companies can make up for it. If that struggling company becomes more of a liability, the fund manager can then replace it with a new company. This is what makes ETFs very reliable investment options. Before we jump into those ETFs, I would be curious to know, what is your favorite ETF? Let me know in the comments below. If you are brand new or just haven't subscribed yet to the channel, please do that so I can keep bringing you more financial content. It's free and it helps me a ton. Canada does have some very solid ETF offerings, which is absolutely fantastic. We are going to look at some of the better ones, and if you stick around until the end, I will give you a bonus ETF that practically screams blue chip. First up, we have the Ishares Sp Tsx 60 Index Etf, which has a ticker of XIU. This is the first of our BlackRock ETFs, and it has been trading since 1990. And guess what? Yes, that makes this the oldest ETF in the world. Some of this fund's holdings include Royal TD and Scotiabanks, Enbridge, Brookfield Asset Management, Canadian National Railway, and of course Canadian Pacific Railway. They have a very good mix of the top 60 Canadian companies. This fund has a market cap of $10.1 billion, and the management expense ratio on this ETF is 0.18%. They do provide a dividend with a yield of 2.279%, which is paid out quarterly in the amount of 22.1 cents per share. The returns that we're going to be looking at with these ETFs are currently down right across the board. That's the bear market. So to give us a better idea of how these ETFs perform, we're going to look at their 2021 returns as well as their current year returns. So for our first ETF in 2021, they saw an ROI, or return on investment, of 26.1%, while in 2022, they're down 12.3%. These are good buy-in prices. You are not going to see a return on investment until we get out of the bear market, but with a solid performance this ETF has had since, 1990, it is a safer bet. Up next, we have Horizons Active Global Dividend ETF, which has a ticker of HAZ. This ETF has been around since 2010, and this one aims to provide consistent dividend income and a wee bit of long-term capital growth by investing in some of the world's best dividend-paying stocks. 61.54% of their holdings are from the American market. Technology makes up their highest sector at 19.33%. From that, it's pretty easy to see that Apple is their biggest stock, making a 5.3% weight in the portfolio. This fund has a market cap of $208 million, and the management expense ratio on this ETF is 0.65%. They do provide a dividend with a yield of 2.351%, which is paid out quarterly in the amount of 24 cents per share. In 2021, they saw an ROI of 28%, while in 2022, they are, of course, down 18.8%. The higher tech weight may feel like a concern, but it really shouldn't. Tech may be hurting in the bear market, but some of the bigger gains may come from the rebound of tech on the other side. This is a good, solid ETF, and one you can easily feed and forget. Next up, we have Vanguard All Equity ETF Portfolio, which has a ticker of VEQT. This ETF has been around since 2019, and it strives to provide long-term capital growth by investing primarily in equity securities. This fund mostly invests in the United States and Canada, which make up 73.1% of the fund. Their highest weighting is in financials, making up 19.5%. Their number one holding is Apple at 2.36%. Their highest Canadian holding is Royal Bank at 1.98%. This fund has a market cap of $1 billion, and the management expense ratio on this ETF is 0.2 0.24%. They do provide a dividend with a yield of 1.628%, which is paid out annually in the amount of 64.2 cents per share. In 2021, they saw an ROI of 21.9%, while in 2022, they're down, 19.7%. Once again, this is a fantastic ETF for just dollar cost averaging in over the bear market. The Vanguard ETFs are some of my favorites when it comes to recommending ETFs for new investors. A big part of that is they do have a track record of reliability. Next up, we have Ishares Sp Tsx Capped Energy Index ETF, which has a ticker of XEG. This ETF has been around since 2001, and it is a perfect way to gain exposure to the Canadian energy sector. This has been an ETF that has made crazy profits in the energy boom and will still be a safe bet for after the bear market, with the possibility of even more pumps as energy soars in response to world events. Their biggest holding, with a weight of 25.2%, is Canadian Natural Resources Limited. Suncor is also up there with 23.2% weight in the fund. This fund has a market cap of $2.0 billion, and the management expense ratio on this ETF is 0.63%. They do provide a dividend with a yield of 2.39%, which is paid out quarterly in the amount of 10.7 cents per share. In 2021, they saw an ROI of 84.5%. Holy banana bread. And guess what? In 2022, they're still up 31.6%. Another holy banana bread for sure. This is just an insane ETF that will reward you when energy booms, and it is ideal to be dollar cost averaging into when energy is not booming as much. In my portfolio, this ETF has been, it's been the holy grail. I promised a bonus ETF that practically screamed blue chip, and that bonus is an American ETF called Fidelity Blue Chip Growth ETF with a ticker of FBCG-A. This is entirely a growth play, so you can hold this in your Wealthsimple USD TFSA without too many concerns. This fund invests 80% of its capital into blue chip companies. An interesting aspect of this ETF is that they like to keep their portfolio under wraps, so other companies cannot copy their performance. This fund, being a newer fund, has a smaller market cap of $340 million, and the management expense ratio on this ETF is 0.59%. They do not typically provide any dividends. In 2021, they saw an ROI of 27.5%, while in 2022, they are down 50.6%. Holy banana bread, not in the good way. This is a newer ETF, as they have only been around since 2020, and they have struggled with the bear market so far. This is not an ETF with a proven track record, so despite the general concept of the fund, which I like, this is one to be cautious with. However, the lessons learned and growth they will experience in the future may make this an ETF worth revisiting as we enter the next bear market. For now, I will stick with safer pastures like Vanguard. Speaking of Vanguard, you should check out my video on Vanguard, or you can try the video YouTube thinks you'll like more. You can decide who's right, and I'll see you in the next video.